everyone, welcome to a new video for Thursday the 31st of October. I am a little late this week, sorry about that, but the reason is first of all that I got tied up on Monday and Tuesday, and then I thought it was a good idea because it is a special week. It's the end of the month, 31st, and we have literally just closed, although the US markets has just closed. It's 10 minutes past 9. We just went off daylight savings time, so the difference in time is now only 5 hours with New York instead of usually 6. And end of the month means that we have completed monthly charts, which I will address in this video. And we are going to start a new month of November, and as the regulars know, that means that we're going to take a look ahead and see what seasonality has to tell us for the upcoming month. So there's no time to waste, let's get started. For this first segment, looking at the monthly charts, I will relatively quickly, go over the charts for all the sectors. Completed monthly charts for all the sectors, make an assessment of where we are in terms of price. This is all price based. This is looking at the longer term trends as you would expect in a monthly chart. And then see if we can wrap that up in a view for the S&P 500. Because today, the 31st, last day of the month, was also actually a pretty bad day for the markets. I'm looking at my screen right now and the S&P 500 closed down 1.86% and the Nasdaq even a little over 2.25% down. So that's a really weak move at the end of the month, and we're going to see whether that impacts the monthly charts and how that impacts the view on the S&P 500. As you know, I will use for this segment the indices, so the S&P 500 indices and not the ETFs, because the indices represent the underlying prices for the ETFs, of course, but there is no impact of dividends, so there's no difference between total return, net return, there's no difference between adjusted or non-adjusted, and the indexes have longer histories, which is what I'd like to address when looking at monthly charts. And the first one that we're going to look at is communication services, and you can immediately see why a long history is so important, because the all-time high, the peak in the communication services sector, was already set back in 1999. That's the previous century, actually. And what you can also see is that we approached that level very closely this month. So the high was 332, a little over 330. And the all-time high here, what was that? 339, so almost 340 is the all-time high. And now this month, we're peaking a little over 330, and you can see here how weak this month actually closed. So we had a nice up run, and then towards the end of the month, and today was a good example, how the market closed towards the lower part of that last bar. The trend for the sector is still up. Monthly trends don't change that easily. And I'm using a very simple gauge to determine the trend. I'm looking at where the highs and lows are, and higher highs, higher lows means an uptrend, and that is still the case. But we're running into resistance. In this sector here, in the communication services sector, we ran into resistance, and we had a little peak here that was formed in July, and we're now running into resistance against the all-time high. So the upside potential for the communication services sector seems a little bit limited. We go at consumer discretionary, we see that this sector is also running into resistance. We don't have to go back as far as for the communication services sector, but here we see that the peak was set in November 2021. We didn't quite approach it, but for the last 2 months we are peaking around 1625. and the high was around 1700. So we're definitely getting there. And for this sector, it also means that the upside potential is now getting slightly limited. Also here, the trend remains up, because if you zoom in on this part here, which is the last 2-3 years, you can see a consistent rhythm of higher highs, higher lows. Here's the chart for consumer staples. And this is actually one of the better charts, because you can see that 3 months ago in August, staples broke out to new highs. It broke out of that trading range that lasted for 2.5 years, and we're still holding up above that breakout level. You can see how this was a weak month for staples. We closed towards the lower part, almost at the low of the month, but we're close to support, which I believe will come in or has to be expected around, let's say, 8.15 and 8.40. The trend here for the staples sector is also still up, higher highs, higher lows. And then we have energy, another sector that is running into resistance. If you look back in history, we have some major areas of resistance. So here is the peak of 2008. That's a little lower than the others. So that's April 2008. Now we had a very important peak here in June, July 2014. And that peak, that level of resistance has been keeping the energy sector under its thumb since May 2022. So we have this peak here in May, June 2022. Here is a cluster of peaks at the end of 2022. Here is a peak in September 2023. And then we peaked above that level in April of this year. We sank back, and then we had a couple of weak months, and all these highs here are formed around 725, 720, 725, and the peak level here for these was 738. So you can see that we're really pushing against resistance. Now, the good news is, if you wish, is if that level breaks, that will unlock a lot of upside potential for the energy sector. However, it is still acting as resistance, which means that the upside potential is limited. And you can see how intra-month, the energy sector now just closed here towards the lower end, almost at the low of this month's trading. The trend is still up, higher, at least higher lows, that's definitely there. And the higher highs are also still there, but it's very shallow, and that also indicates that resistance is pushing on the market for this sector. And here is financials. That is a good sector. It broke out to new highs. We had a little consolidation taking place here, let's say in the first half of 2024. And then we broke out, and this month, the month of October, was a pretty good month for the financial sector. And this is closed around the middle of the range, but you can see how this last month actually peaks above the highs of the previous 2 months. So this sector is definitely keeping up its rhythm of higher highs and higher lows and remains in an uptrend. And here is the healthcare sector. This is I think we can qualify this as a typical chart for a defensive sector. Has been trading in a range, just like the staples chart that we just saw for 2.5 years. We broke out, found new resistance. We broke out again, and now you can see that healthcare dropped back into that former resistance zone, which is now acting as support. The rhythm of higher highs and higher lows, especially since the low here at the end of last year, is still in place, so the trend is still qualifying as up. And this one actually moved to new highs, so this is one of the few sectors that actually peaked above their all-time high levels, confirming the longer-term uptrend. Industrials, that's another sector that definitely confirmed its uptrend. Series of higher highs and higher lows is still in place. We do see how this sector also dropped back to the low of the month. So we had a pretty good month. So we made a new all-time high intra-month around 1180. And then for the close, we actually closed lower than the previous month. So during the month, this sector actually peaked and then rolled over and started to move lower. The trend, the long-term trend, as I said, higher highs and higher lows in the monthly bars is still present. Information technology, everybody knows this chart. or so I think. What we see here is that this sector also tested resistance. The peak was set in July 2024, which was slightly higher than June 2024. And we were in that zone, in that range here in October, around 4,600. But also technology started to move lower in the second half of the month, and we closed in the bottom half of the range. Again, the sector's series of higher highs and higher lows is still very present, but we are pushing against resistance, and that's a theme that we see in a lot of sectors. I'm not going to say all of them because staples broke out, healthcare broke out, industrials broke out, so it's not all of them, but there are some very important sectors that are pushing against long-term resistance levels, and that's keeping the market under pressure. That makes it hard for the market to break higher. Once it happens, it'll have a very good effect, but the question is, when will it happen? Here is materials. Again, a sector that for the last couple of months pushed against resistance. We broke above it last month, so the month of September, we actually moved higher. We moved above that level of resistance. But look at the last month's trading here. We put in a slightly higher high than last month, but the second half of the month, materials actually rolled over and dropped back, and also this sector is closing at the lower end of the range, almost at the low of the month. It now dropped back into the former resistance zone, which is now starting to act as support. The trend is still there, higher highs and higher lows, that rhythm is unbroken, that's still present. The real estate sector, definitely not pushing against all-time high levels, but just came out of a large consolidation, a large bottoming formation. We saw the break 3 months ago, and this month is the first month where we actually have the bar, so the high of the bar of the month is lower than the high of the bar of the previous month, and the low of the bar is lower than the bar of the previous month. The close is also towards the lower end of the range. The breakout is still very valid, but you can see that this sector matches and synchronizes with what we saw in a lot of other sectors where the beginning of the month was pretty good. Now we set a high and then we roll over and we started to move towards the lower end of the month. Real estate is no different. The positive thing where real estate stands out is that the breakout level is still there, and there is expectedly good support between, let's say, 260 and 267, 265, which is the old breakout zone, which is now expected to start acting as support. Utilities, the third defensive sector, and it broke to new highs last month in September when we took out the resistance which was formed off of the March 2022 and August and September 2022 highs. That break was there. We can see again the same story as with the previous chart, where the sector moved higher during the month, and then second half of the month we roll over and we close in the lower half of the range of the bar, and utilities are doing the exact same thing. They're still holding up above the breakout level. So this level here, which is just below, let's say 400, a little bit below 400, 395, 400 is where the previous high was and where we can now expect support to come in. Again, the series of higher highs and higher lows for the utility sector still very present. And that leads to the chart of the S&P 500. And with all these sectors still in uptrends, it's not strange that this chart is also still in an uptrend. But here also you see the same behavior where we had a good start of the month, but the S&P 500 closed towards the lower end of the range for this month. And although it's not as clearly visible, you can see how this S&P chart is the summation of all the sectors, also impacted by the weight of these sectors, which shows a very nice breakout and a move higher. But I hope that you agree with me that a lot of the charts that we just saw for the individual sectors were pushing against resistance and showing pressure on the market. And I want to wrap up this segment with a look at a shorter term chart of the S&P 500, the weekly and even the daily, to see how that latest price action might impact the overall market in coming weeks. The weekly chart of SPY, we see the breakout that was very clearly there for weeks already. That happened mid-September. And now we peaked at 586 and we're dropping back. So I think that the area around where this previous peak was formed, around 565, is now going to be a very important support level for the S&P 500. We may see some buying coming in at that level, and it'll be very important to see how strong that buying is and whether that 565 peak can hold as a support level for SPY, for the S&P 500. The daily, before I move on to the daily chart, so the divergences between the RSI and price, as we talked about it a few times before in this video, in these programs, the negative divergence with the RSI is not as pronounced as they sometimes happen to be in the past. I still consider this to be at least a marginal divergence, because the peaks in the RSI are at the same level, where the peaks in the price were clearly higher. And that happened again here with this peak in the RSI, which corresponds with this peak here, and then the last peak in the RSI, which corresponds with the highest price here around 586. The RSI wasn't able to put in a higher high, while the price did exactly that. If you look at the MACD, there is a clear divergence visible. The last three highs in the MACD were all lower, while the last three highs in price were all higher. Now, what does that mean? How does that look on the daily chart for SPY? And I think, what I think I'm seeing here is a gap lower. This is today, this is just closed, a gap lower, which also completes a double top pattern in the S&P 500. So this break of support around 575, I think, marks the end of this trend on the daily chart. And here is the 565, is the level that we just saw on that weekly chart. But here it's a little bit more pronounced and a little bit more detailed. And you can see how there's 1, 2, 3, 4, and then after the breakout, another 1, 2 times that level came back either as support or as resistance. So that 565 area, I'm going to monitor very closely, because I think that that's where the market will give us crucial information about the future move. From a daily perspective, I think that the market here has completed a double top and is at the minimum on its way to 565 as support. And if that breaks, the next level I'm watching is around 540. Now that would mean a more serious corrective move after all the upside that we had. And here on this daily chart, you see a pretty pronounced negative divergence in the RSI, which was already lingering under the hood and is now coming to full fruition with the RSI breaking well below 50 and well below its previous low. All in all, I wouldn't be surprised if this move in the S&P 500 marks the start of a slightly larger corrective move. It looks as if we need to digest the recent up move, and I'm talking about the move that started at the beginning of August and which basically ended at the start of October, mid-October. And this is the move. So this is mid-October and we move towards the end of the month. This is the move that when we talked about the individual monthly charts, where the start of the month was pretty good, and then in the second half of the month, the market started to roll over, and a lot of these sectors are now closing either against or at the low of the month, or at least in the lower half of that monthly bar. And that is exactly what you see happening here on this daily price chart. Well, and then seasonality, and it's actually quite ironic that with the view that I just gave you on the monthly charts, that a lot of sectors were pushing against resistance, and that the S&P 500 just completed a double top on the daily chart and might be on the way to some lower levels. And then when you look at the seasonal patterns, it's getting interesting because on a seasonal basis, traditionally, together with April, November uses to be the strongest month for the S&P 500. 80% of the time, SPY closed higher than it opened. So that's an interesting statistic. And the average gain for the month of November is 2.5%. With the charts that I just showed you and the current constellation and the formation that we saw completed, I find it hard to see SPY moving higher 2.5% in the next couple of weeks. It is possible, but I'll believe it will be a hard nut to crack for the market. If you look at the individual sectors, there are some very pronounced. Over the last couple of months, we had always like, oh, these are 50-50 calls. But if you look at the seasonal patterns for the month of November, that's actually one of the months with quite a great dispersion between outperformers and underperformers. And if we just look at this bar here, this line for November, then you can see how materials 65% of the time closed higher or outperformed the S&P 500. These numbers are all outperformance. And historically, materials outperformed the S&P 500 by 1%. That's a very decent level of outperformance. If we look at the way to the right here, 85% of the time, that's actually the highest level in the table, 85% of the time, the industrial sector outperformed the S&P 500 in the month of November. And it gained 1.3% of outperformance over SPY in that month. So industrials, from a seasonal point of view, industrials is the sector with the highest expectations from a seasonal perspective. And it's followed by, I'm going to say, materials, 65%, and an expected return, an expected overperformance of 1% over SPY. Now, interestingly enough, there are also quite a few sectors that are pointing the other way. And we start here with real estate. 35% of the time it moved higher, it outperformed, which means that 65% of the time the real estate sector underperformed the S&P 500. But also look at the average return, that is minus 1.2%, so 1.2% lower than SPY. And this is interesting because 1.2% lower than SPY still means a 1.3% gain for the month. So don't take this the wrong way. This is not telling you that real estate is expected to go down 1.2%. It's telling you that it's underperforming, or it's not going to do anything. The expectation is that it will underperform the S&P by 1.2%. And if the S&P fulfills its expectation, that means that real estate would still be higher. Now, that is a questionable thing for this month, but just to make sure that you read the table correctly. And then the other one that is interesting is utilities. That is the lowest level on the table. So sorry, I'm looking at the wrong month. So November, 35%, one of the lower numbers on the table. Utilities are outperforming. That means that 65% of the time they're underperforming, and the average underperformance is 1.6% under SPY. So utilities, which we saw was a sector that just broke out and held up above its breakout level, is expected to underperform SPY in the coming months from a seasonal perspective. And if we go further to the right, and there is one more here, and that is the energy sector. Same reading, 35%, 65% of the time underperforming. The expected underperformance here for the energy sector is only 20 basis points. So I think November is one of the months with the biggest differences, the largest dispersion between the expected outperformance and underperformance, but also in terms of the levels of underperformance and outperformance. With the current setup, it's a hard ball. It's a hard call to make from a seasonal perspective. I'm a little bit more convinced of some upcoming weakness in the S&P 500 based on that double top formation and the fact that the S&P was pushing against resistance and the fact that a lot of these sectors are pushing against resistance. But let's take this seasonality table to a relative rotation graph and see where especially the sectors with the high and the low readings are positioned and what we could expect from that relative rotation perspective for the next couple of weeks. So here's the weekly RRG for those sectors, and let me highlight those tails for you that we want to talk about. So that's on the positive side, that is materials. That's right here, and you can see how it is positioned inside improving, but it's moving towards the right. So, and again, this is a relative chart. So the SPY, the price of SPY is in the middle. So we're looking at relative performance, and the expectation for materials, I can see that it is moving higher on the RS ratio scale, which is moving towards the leading quadrant, which is good, and it is at a stable relative momentum level. I would prefer that momentum level to pick up a little bit, especially when it moves into the leading quadrant, but for now, the materials sector seems to be on track to move higher in terms of RS ratio. That is the metric for relative trend. So the materials sector seems to be in sync with its seasonal expectation, on track to outperform the S&P 500, whatever the move of the S&P 500 will be in the month of November. Now the second tail that we need to look at from a positive perspective is industrials. This sector has already moved into the leading quadrant, but you can see that it is losing relative momentum. Now, as long as it moves higher on the RS ratio scale, I'm going to give it the benefit of the doubt, because that means that the relative trend continues to increase, albeit at a lower pace, at a lower rate of change. Industrials still positioned inside the leading quadrant and moving higher on the RS ratio scale. So this sector also seems to be on track for its seasonal performance, just like the materials sector. Now for the ones that are showing a less favorable seasonal pattern, seasonal expectation. And the first one is the real estate sector. You can see a long tail coming down out of the leading quadrant and just crossing into weakening. Now, it is one of the stronger sectors, but as you can see, it has completed a very strong move, and it's now with a long tail, which means that there is quite a bit of power behind it, pushing into the weakening quadrant. And the month is only 4 weekly observations, and if I look at this tail, I wouldn't be surprised if we find XLRE real estate in 4 weeks' time, 4 nodes' time, pushing further into the weakening quadrant, which doesn't mean that it's reversed its relative uptrend, which is still there, but in the near term is underperforming the S&P 500 while it is going through a correction, a relative momentum setback. So the real estate sector actually pretty well on track to match with its seasonal expectations. The energy sector, which is right here, is way to the left. And this is a little bit more problematic. I can easily say that this is the lowest reading on the RS ratio scale, which totally corresponds with a weak performance for the energy sector in the month of November. And it's also, that is easier to say, because if you look at the energy sector, this move here is pretty long, but in the grander scale of things, this tail here is way shorter than the one that we saw for real estate. So the odds that the energy tail will not do much and maybe even roll over in the next couple of weeks is very well present. I think that the odds for the energy sector to roll over, maybe even inside the lagging quadrant or while it has just hit improving, are way higher than for the real estate sector to immediately roll higher in the next couple of weeks. So even despite, I'm going to say, the little uptick that we see here in the energy tail, I feel that the odds are pretty good for this sector to be in sync with its seasonal pattern, which means that an underperformance for the month of November in energy. And then the last sector, and that's interesting, it's the strongest sector in terms of performance, one of the strongest sectors, utilities. Now also pointing lower, just like the real estate sector. The tail is not as long as the real estate sector, but I wouldn't be surprised to see some underperformance coming from utilities in the next couple of weeks. For me, this one is the least, I'm going to say, reliable, given the breakout, the upside break that we saw on the monthly chart and the weakness that we see here. Combine that with the weakness that we saw in the seasonal pattern. I can totally see how this sector, just like real estate, will underperform the S&P 500 while maintaining its longer term relative uptrend. So the month of November, all in all, probably going to be a pretty interesting month from both the longer term perspective to see how these price bars will respond to the various resistance levels, as well as the seasonal patterns, how they play out on the RRG. Obviously, this weekly RRG is a slightly shorter term outlook than those monthly charts. But here we see tails that are pretty good in sync with the seasonal expectations. The only thing where I see a big discrepancy is for SPY. So SPY is expected to do really well in November, and I don't see that on the price chart. Now, as you know, it's all relative, so even if SPY comes down, these relative trends can play out very nicely and confirm the seasonal patterns that we just discussed. Market in general under pressure, conflicting with its seasonal tendency, and we need to wait and see how that plays out. For the individual sectors, on the other hand, the picture seems a lot clearer, with strong tails and strong moves and expected outperformance for materials and industrials, and underperformance for real estate, energy, and utilities in the coming month of November. And that's it for this week. Thank you for watching, and as usual, I hope you enjoyed the show. Let me know your thoughts in the comments below, and I'm looking forward to seeing you again next week, same time, same place. Although I hope I'll do it again on Monday or Tuesday.